Welcome to The Explainer. Today, we're diving into a really interesting analysis of Bitcoin's future, because right now, we're seeing two powerful and totally conflicting forces at play. On one side, we have a technical signal that has, in the past, been a warning for massive crashes. But on the other, there's a strong argument that we're actually on the verge of a huge, unprecedented rally.
Okay, so let's get right into it because a pretty serious warning sign has just popped up on the charts. And look, this isn't just some random indicator. This one has a very real track record for calling major downturns. So the big question on everyone's mind is, does the past still apply to where Bitcoin is today?
So the signal we're talking about is called the MACD bearish cross. And to really get why some traders are getting a little nervous, we've got to look back at what happened the last couple of times this exact same pattern showed up.
All right, so let's break down what this actually means without getting too technical. Just think of it like this. You have two lines tracking Bitcoin's momentum. One is for the short term, and the other is for the long term. A bearish cross is what happens when that short-term momentum line dips down below the long-term one. Now, on a 2-month chart like this one, that's a really big deal. It suggests the recent weakness isn't just a blip and that the bears might be about to take control for a while.
Now, this is what's so wild. This signal is incredibly rare. On this long-term chart, it has only shown up twice before in Bitcoin's entire history. And both times, well, it was followed by a pretty catastrophic price collapse. We're talking about drops of over 65% each time. And right now, as you can see, it has just appeared for the third time. So let's just put that into perspective for a second. If history were to repeat itself, if we saw a pullback of that same magnitude today, it would wipe out tens of thousands of dollars from Bitcoin's current value. It would send the price crashing all the way back down to the $40,000 level. It's a sobering thought, and it's exactly why you can't just ignore a signal like this. But, and this is a huge but, here's where things get really fascinating. The analyst we're looking at, Satoshi Stacker, he argues that even with this ominous signal flashing, the old patterns might not apply anymore. He thinks the entire market has fundamentally changed.
His entire case really hangs on this one powerful idea, that comparing the Bitcoin market of today to the one from 2022 or even earlier is just a mistake. The whole context, the whole environment is completely different.
And this slide really nails the heart of the bullish argument. You see, unlike those previous downturns, we are in the middle of a historic, liquidity-fueled rally across all the major asset classes. Stocks, gold, silver, they're all hitting record highs. In this kind of environment, Bitcoin is actually the outlier. It's the one major asset that seems to be lagging behind, which could be setting it up for a massive catch-up trade.
So let's get into the main piece of evidence for this theory, and it involves looking at Bitcoin's relationship with another key asset, gold.
When you put these two side by side, a really interesting pattern starts to emerge. Gold, the classic store of value, has already made its big move. It broke out to a new all-time high. But Bitcoin, which people often call digital gold, and tends to follow similar big-picture trends, well, it hasn't made that same definitive move yet. This is the lag the analyst is pointing.
And so, the prediction here is that Bitcoin is simply on a delay. If you look at history, it often trails gold's major moves by about 4 to 7 months. So if that pattern holds true, then the huge rally we've already seen in gold might just be a preview of what's coming for Bitcoin, and maybe, just maybe, in an even more powerful way. So, you might be asking, what could possibly be strong enough to trigger a move like that and just completely override that bearish technical signal? Well, the answer, according to this analysis, comes down to a fundamental and pretty dramatic shift in good old supply and demand. First, just look at the demand side, because this is where things are completely different this time. The launch of the spot Bitcoin ETFs has opened the floodgates for institutional money. I mean, to put a number on it, we're seeing single days with inflows of over $800 million. This is a brand new dynamic that just didn't exist in any of the previous market cycles. And this isn't just some short-term blip either. You have major players like JP Morgan predicting this wave of capital is going to swell to over $130 billion in just the next couple of years. This represents a constant, massive, and relentless source of buying pressure. So what this does is it creates the perfect setup for a classic supply shock. It's actually really similar to what we saw happen in the gold market. At first, all this huge new demand is met by people who've been holding for a while and are happy to sell. But eventually, that supply of willing sellers starts to dry up. They basically run out of ammo. And when that happens, you're left with this massive, unyielding wall of demand and very little Bitcoin available for sale, which, as you can imagine, can lead to a really explosive move in price. Okay, So this brings us to our final summary, which is really a snapshot of these two powerful, opposing forces that are battling it out in the Bitcoin market right now.
So the key takeaway here is that while the short-term picture looks pretty cautious, there's some significant resistance ahead that could definitely cause some pullbacks. The long-term outlook is being shaped by these completely new market dynamics. You've got these bearish technical signals fighting against bullish fundamentals on a scale that, frankly, we've just never seen before.
And that leads us with the ultimate question. The Bitcoin of today, with all its ETF inflows and institutional money, is a fundamentally different asset than the one that existed during the last bearish cross. So, are those historical patterns and signals still relevant? Or are we in a totally new paradigm where the old rules simply don't apply anymore?